Hey folks, Dan Frio here, the Mortgage Update. Today is August 25th, special edition, alert out. Mortgage-backed securities are getting crushed right now. So if you're a mortgage advisor out there and have not locked in your clients, please do so fast. If you're closing within the next 2-3 weeks, if not, you might just want to hold off because when you do get your rate sheets today, this number will probably already be priced in. So let's get on what's going on in the markets. I post this because a lot of mortgage people don't follow this. They just see when they get a new rate sheet, they're like, oh, rates just went up. I wish I knew or whatever. Got to be proactive. I always say be proactive, not reactive. And now I'm going to also show you why pigs get fat, hogs get slaughtered. If you stay on the sidelines and you're waiting for the ultimate low, you can never time it unless you're purely lucky. So let's get on to it. What's going on today? Right now we see the MBS market down 20. And like I always say, red is bad, means rates are going up. Green is good, rates are coming down. That being said, red, this is a big move. We're going to see rates move today and probably interest rates go up at least 0.125 to 0.25. And why? What's causing this? So just a brief, what is this number here? And why do we even care, what this is doing? Well, this is mortgage-backed securities right here. Mortgage-backed securities. It's a bond that trades throughout, banks, investment firms, and whatever. You probably even have it in your 401k if you have a retirement plan. And this is what's happening to the price of a bond. So basically how prices and bonds work is the more you pay for a bond, the less the yield. So we want to pay more for a bond because it's going to reduce the yield on mortgage rates. So the yield is the interest rate, which is the mortgage rate. Best way for me to explain that. And you might see this starting to roll because we're live right now. It's August 25th at 10:27 Central Standard Time. So what we're watching here is, green is good. As this market's moving up like this, rates are getting better. And then you have the pullbacks. Okay, rates got better. And then right through here, we basically locked everybody. Since then, I was saying, there was kind of a head and shoulders technique that took place here. I won't go through that specifically, but in a lot of charts, you have patterns that we follow. So when we broke out in certain areas, I was like, okay, let's lock everybody in because this is probably we're going to have a pullback. Every market has it. There's nothing goes straight up, nothing goes straight down. So what happens is these are trend lines right here. This is a short-term ceiling. This is a long-term ceiling. Short-term floor, long-term floor. These are all called Fibonacci levels. And so what happens is you should trend in areas like this long-term, and you'll go in there. So it's like, think of picking a stock. You're trying to time this thing the best you can based on technicals, along with a lot of other things. Okay, so that's long term. That's how the cycle should run. Short term, we should be running through these areas. Okay, and this is what I mean. The price or the yields are kind of bouncing around. This is the price of mortgage-backed securities. When we hit here, I was like, okay, we keep hitting a resistance line right here. We hit it. We hit it. We hit it. We hit it. I'm like, okay, this isn't good news. In a normal market, we should have been trending right through here is what I've been saying. And for short term, long term, we should be basically in the middle of these two trend lines right here and here. All right. What these trend lines are, again, these are the ceilings and floors, short term, long term. And then you have other lines in here that are moving averages. So they basically blend these numbers and they average it over 25 days, 50 days, 100 and 200. Okay, that's where we're seeing right here. So we should be kind of, in the shorter term, we should have been trading in a range about through here, which we did have that pullback, and you can see it here and here. We tested those levels, and then we keep hitting resistance there, hitting it. Now we're down below. So the new resistance line, I feel, is going to be right in this area right here. and that's where we're staying right now. All right. So what's causing this? Well, mortgage rates get better the worse the economy's doing. And normally the worse the stock market's doing, or people's confidence. So if you're leery of your job, you're leery of the economy, you're leery of a bunch of things, you're not going to buy stocks, because that is predicated on a good a good market for businesses. So if your concern is there, you usually come out of stocks and buy bonds. And that's what this represents here. It's a bond. So you have security, you're getting a percentage rate of return, and so forth. So what's happening now is, some fears of some things are coming out of the market, such as, the biggest thing right now is the pandemic, the coronavirus. That's huge. A lot of you probably didn't realize also the tension with China. Okay, so those are the big two world events that are causing a huge uncertainty in the markets, and causing people to fear things, not only here in the U.S., but all over the world. So what's happening right now, though, is U.S. trade talks with China are easing a little bit. All right, so that's good for the stock market. Again, what's good for the stock market isn't good for the bond market. Let's say you have $100 to invest. If everything is going awesome, you're going to spend all $100 on stocks, and you're going to invest in stocks. If there's uncertainty, let's say there's a little uncertainty in the world, you might say, you know what, I'll buy 50% of bonds and 50% of stocks. So then you do that. If there's huge uncertainty out there, you're going to say, you know what, the stock market, I'm not comfortable with that. I'm going to put all my money into bonds. And this is one bond instrument that you can invest in. So it's supply demand. As more people are jumping into this market, the higher the demand, so which increases the price, that drives down the yields. Hope you follow me. There's an inverse. The more you pay for the bond, it drives down the yields. All right. So people were basically they were scared between the pandemic and everything else going on. They're like, okay, we're going to jump into bonds. Also, the Federal Reserve jumped in, and they're buying bonds, and thus creating bigger demand for the mortgage-backed securities market, thus raising rates. Okay, so now we take off the table China. We might be getting better trade deals with China, or better talks. So that's for the investment world or stock world, that's good for manufacturing and other business sectors. So that opens up some things where people say, okay, I might go now start dabbling more in stocks. I'm a little less concerned of what the tensions are there. The coronavirus is huge, as we all know. As soon as there's a cure or a vaccine for it, you're going to see euphoria through the markets, and people are going to say, okay, everything is going to get better. And thus, it's good for stocks. Both of those are bad for bonds. So as people pull out the demand for bonds, it drives up or down the price, and thus increasing the yield. So if you don't have as much demand for bonds, it's driving down the price and the yields up. That's what we're seeing today. So between some promising news in regards to plasma and some other things with the coronavirus, plus news that we're in renegotiation talks with China, you're starting to see a pullback in the markets, and you can see that right here. Hold on, this probably refreshed it. But we do have some great news on the housing front. Housing building prices, everything is starting to surge, as you can see here. Building is up, values are up. I'm going to do a video this afternoon on the housing bubble and my knowledge of that and what my predictions are on that. So right now, though, you can see mortgage-backed securities are getting hammered. So if you have clients out there, if you're a mortgage advisor, I would suggest you lock. If you're a realtor, get a hold of your clients and say, let's lock. If you're one of our clients, you probably are already locked. And then we're going to continue to monitor this on a minute by minute basis. If you need any assistance from me personally, please go to therateupdate.com. right here you can find the phone number to reach me personally. It's 844-775-LOAN. That's 844-775-5626. My name is Dan Frio. You can email me at D for Dan Frio, which is FRIO, at preferredrate.com. I'd love to help you if I can. So that's it for right now. I will be posting later this afternoon where we end up for the day. And then I also am creating a housing bubble video for later today. I don't think we have as much concerns as a lot of people are posting. And I think a lot of it is clickbait. And I'll explain that later on that. So thank you so much for watching. God bless. Have a great day. Don't forget to subscribe down below. Click the bell so every time I do post a video, you get an alert. And I'd love to hear from you. So talk to you soon. Bye-bye.